Let's talk about oil and gas for a bit, because there's an interesting pullback which has happened globally in the price of crude, up to $53 again. That's picked up a few of the oil and gas stocks out here. However, ONGC, if the Nifty moves to free float index, will lose quite a bit of its weightage. To talk about some of these oil and gas heavyweights, Jal Irani of Macquarie Securities, who's been tracking this sector for a very long time, is with us now. Jal, morning. Thanks for joining in. What's your sense of how the upstream companies or upstream stocks like KN and ONGC might do now with the recovery in the price of crude?
KN is directly related to oil prices, so KN would be the obvious immediate beneficiary of oil prices, potential oil price increase. So obviously KN will do the best, followed by ONGC and Reliance to a lesser extent, because Reliance is more gas than oil. But I think in the Indian context, the opportunity for the oil and gas companies is significantly beyond prices. It's essentially, the opportunity is that India is actually on the threshold of not only starting very large production, and yet that is the tip of the iceberg, which I think makes these stocks very attractive.
Jal, morning. The biggest event in the recent past for the market was the RIL-RPL merger. How did you read that?
I think there are obvious synergies in the RIL-RPL merger. Clearly the two capacities together can optimize profitability. It makes it the largest location, single most and the highest sort of complex refinery anywhere in the world. That has got a significant benefit. Also, given the fact that the new refinery is on the verge of starting, the risk is minimized, and therefore the timing of the merger is also appropriate. So there are obvious benefits there.
In the light of what has happened to crude, Jal, how would you approach the oil marketing companies or even the standalone refineries in the public sector at this point in time?
The marketing companies tend to be counter-cyclicals to oil prices. So if oil goes up, they get back into the subsidy mechanism. The break-even level roughly is about $52 a barrel. So I think they're pretty much close to those levels now. So therefore, oil going up is not very good for the marketing companies. Having said that, these marketing companies also half refineries, and half the business is from refining. Now, the inventory losses as a result of crude oil prices that declined last quarter is going to be absent in this quarter. If anything, there's potential for inventory gains in this quarter. So they would be significantly better off in this. The refinery specifically would be significantly better off in this quarter.
What is your own estimate, Jal, of the kind of subsidy burden that ONGC might have to bear for the next financial year?
Well, I don't remember that number offhand, but really it is subject to oil prices, and it's subject to oil prices. I don't remember the number offhand.
So what's your top pick in the sector, downstream or upstream, Jal, at this point?
I think Reliance Industries followed by KN India would be the top picks. See, India is on the verge, both these companies especially, are on the verge of starting up massive oil and gas production together, and in fact starting from the next quarter itself, April itself. Together, you'd be amazed that these guys are going to add 0.5% to global oil and gas production. To put this into context, the production which starts is equal to 1/3 of the Gulf of Mexico's current production, or 1/3 of Brazil's production, and in fact it doubles India's upstream production. This is firstly not only very profitable production, but this is also the tip of the iceberg. It is very profitable because the size of the finds are massive. So, for example, Reliance Industries, just from 5% of KG-D6 area, which is one of the 200-odd net blocks handed out, is going to produce as much as 1/4 of the Gulf of Mexico. So the size of these fines is massive. Now, why is it the tip of the iceberg? Because essentially the geological plays, especially on the East Coast, suggest that there are what we call biogeneric corridors, i.e. hydrocarbon-rich corridors, which run not only right across KGD6, mind you, KGD6 alone could replicate the Gulf of Mexico, but not only they run right across KGD6, but run into several other blocks on the East Coast, not only in the Krishna-Godavari basin, but Kaveri down south and the Mahanadi basin up front. So really the upstream opportunity is not only immediate, starting the next quarter, but also runs into perhaps the next decade. So it's a humongous opportunity about to unfold. To put it also into an economic context, or calculations suggest that this initial production which starts is going to add 1.7% to GDP, or is India imports about 75% of its oil requirements. India's imports could go to roughly 50%. So even from a macroeconomic perspective, this is a very large production starting, and yet the tip of the iceberg, and these companies are obviously the direct significant beneficiaries.
Irani, appreciate you joining in today. Thanks very much as always. That's the Macquarie view on oil and gas. They're quite bullish on some of the largest companies like Reliance and Cairn.